Welcome to the Finance Podcast. The topic of this episode, the wealth revolution in private markets, 4 predictions for 2030 by Jan-Marc Ferg, Jocelyn Pidou and Luc Maruenda, moderated by Simon Jennings.
Really what changed in the last 5 years is the proliferation of open-ended evergreen vehicles, where there is liquidity on a monthly or a quarterly basis. That is really what I think has captured people's imagination. It's what I think people most associate with democratization, and I would call that democratization 3.0. So it's not new, but it happened really slowly, and then it happened really quickly. Today on the panel, we'd like to talk about democratization 4.0. What comes next? And I'm going to highlight some predictions, some of which I really believe in, others of which are perhaps there for discussion purposes. Am I pressing the right button? Thank you. You might not be able to read all of those. 4 predictions which our panel is going to discuss today. The first is that by 2030, the distinction between public and private markets will be irrelevant. The second is that, and if you think about the way private markets is positioned today, it's usually as a product which is bought by a client. That's called advisory in the private bank world or the private client distribution world. My prediction is that by 2030, 50% or more than 50% of the private wealth capital going into private markets will come from discretionary pools of capital. In other words, a CIO will be allocating or fulfilling an allocation to private markets rather than an individual client buying a private market product. Cannibalization is a lot of the talk at the moment about those feeder vehicles that I talked about that invest into closed-end 10-year funds. Will they still exist? Actually, will the open-ended evergreen with monthly or quarterly liquidity, will they take over entirely? And my prediction is quite the opposite, that actually by 2030, it'll be fairly evenly split between closed-end and open-ended funds. And finally, if the penetration rate, awful word, but if the penetration rate of the eligible universe of private clients that invest in private markets today is 2%, and it might be much more than that, it might be much less. But let's use that as a reference point. If it's 2% today, it will grow by a factor of 5 and be 10% by 2030. So those are our predictions. I'm going to hand over to the panel now to introduce themselves, and then we will ask them to discuss, debate their own position on each of these. We would welcome questions from the audience perhaps at the end, but if you really have a burning question, just wave and it's relevant to that particular topic, just wave and we'll answer your question. Thank you. Jan-Marc.
Okay, so I'm very happy to be here. Thank you, Simon. Jan-Marc Ferg. I'm with HSBC and I lead on a global basis investments and managed solutions for private banking and wealth management clients. As HSBC, we are operating across the globe, obviously 2 home markets, Hong Kong and the UK, but around the private banking here in Switzerland and are very active in the Middle East. My portfolio includes basically everything that has to do with investments, so mutual funds, discretionary portfolio management, and alternatives, which includes private markets.
Hi, Jocelyn Pidou. I'm head of asset manager solutions for EMEA at iCapital, managing director, based here in Zurich. iCapital is a platform, and we have a very simple mission, which is to facilitate fundraising from GPs and asset managers, from private wealth and from banks, and to help those banks and advisors then invest their clients' capital in private markets. So we have a technology platform and we assist in structuring and other solutions to help unblock these barriers that have traditionally blocked those 2 parties from coming together.
Good afternoon, everybody. I'm Luc Marmeda. I'm in charge of wealth solutions at Eurazeo. Eurazeo is an asset manager dedicated solely entirely to private markets. We're based in Paris. We manage 36 billion euros. And what we do at Eurazeo and at the wealth solution department specifically is we structure funds dedicated to private clients. Those funds are mostly parallel funds to the large institutional solutions we provide for the other investors. And I've been doing that for 25 years, so a lot of experience.
Thank you, panelists. Perhaps a few words on myself. I started at UBS as a graduate trainee in a year that I care no longer to remember, but it was a long time ago. I had, as I said, the great fortune to be able to be one of the founders of the UBS wealth management private markets business, and then the same at HSBC, and I'm now at HarbourVest, which is a global private equity firm focused on EMEA and APAC private client solutions. So, with the introductions over with, Luc, I'm going to turn to you. You're in the hot seat first. And this is particularly relevant today, I think, with the volatility that we're seeing in public markets. But that first prediction, the distinction between public and private markets, there's a lot of academic research that says clients at a certain level can tolerate illiquidity, and therefore the distinction between private and public markets should be irrelevant. Is that something that you agree with?
Not really. Because you have to look at those markets are very different. Also, you see in the market more and more evergreen vehicles coming. I mean, we have one started like 7 years ago, which is a 3 billion evergreen solution. So we have experienced, and our solution is semi-liquid. One should never forget that the underlying companies we have in our portfolios are not listed on the stock market. It means that whatever sort of liquidity might be structured in an evergreen vehicle, it's a semi-liquidity. It means that at one point, maybe tomorrow, maybe in 5 years' time, there will be a dark event in which trust will be out of the market because stock market is going down. Remember first quarter 2009 when everybody wanted to sell because we were in the middle of the financial crisis. In this case, where clearly evergreen solutions for private markets will not be fulfilling full liquidity. It is not possible because if you do that, of course you can provide liquidity, but you will shoot yourself in the foot because, of course, you will have to totally abandon your portfolio with zero value almost. So you will be destroying a lot of value. So always keep in mind, you probably are in contact with a lot of private investors. Always keep in mind that going to private market has to be a diversification in the allocation of your portfolio. And you should be able to bear some illiquidity for some times, because our funds, typically, we are structuring gates, and those gates allow a certain amount of redemption every quarter or every month, depending on the fund. But the rule of the market today is about 5% of the NAV every quarter in those funds. So, and there is a reason why we have a cap at 5% per quarter, is because should there be an event where everybody needs liquidity, we have to prevent that, and we have to close the fund because in the interest of the clients, because also this is a way to preserve the value in the portfolio. So everybody has to really understand that before it goes into evergreen fund on the private market. Having said that, that's not the end of the world, because, and maybe Jocelyn will be able to talk more about that, but there is a intrinsic liquidity structuring in those evergreen solutions, but then you can have also some trading of evergreen solutions. And I think technology, special markets, are going to emerge with solutions to enable trades of private market funds. So then you will have a market which could be in a way quite similar to the public market. Also, there may be some discount to the NAV because people know that those underlying assets are not liquid. But it may be a way to think about how the future and the technology will be able to help on these liquidity issues. But always remember that an evergreen solution on private market semi-liquid, it's semi-liquid. It's not fully liquid, so that you will never be able to have full liquidity. You need to educate yourself, of course, and all the private clients who want to access those funds. They're great. They can invest mostly sometime on a weekly basis. They can sometimes ask redemption on a monthly basis, sometimes even less. But always keep in mind this is semi-liquid.
So, Luc, thank you for that. I think you've very eloquently destroyed my first prediction, that public and private markets will continue to coexist alongside each other for reasons of suitability, diversification. One should keep those separate in a strategic asset allocation.
I believe so, yeah.
Jocelyn, Jan-Marc, any additional thoughts, any disagreement with that?
Yeah, I probably can't help you with that prediction. I agree in principle. But I think beyond maybe just a couple of additional points, beyond the liquidity aspect, which you very nicely explained. So clearly from a portfolio optimization perspective, obviously all these asset classes find their way into a strategic asset allocation based on their risk-return characteristics. But particularly on the private market side, there are other features than the potential illiquidity, which are also important at this stage. And obviously often private markets are still considered in many jurisdictions as complex products. So there is the need to explain much better. It's the ultimate form of active management. So clients who have invested so far only in public market and follow the public markets might see quite a deviation in outcomes by adding private markets in a positive sense or in a negative sense. But I think we're going to talk about that. And then there's simply other features, like you mentioned, the transparency. Obviously, regulators have their say as well. And I just don't think by 2030 this is something which has fully made its way into either asset allocation or in portfolio allocations. And maybe the last thing I want to mention here as well, because of the, particularly for private wealth portfolios, heavy under-representation of private markets, I think we're still in a phase for the next few years where there will just be a lot of training, education, a lot of explaining needed for private clients to build the appropriate allocation.
So I'd like to pick up on that point because the training and education, honestly, it's something that many of us in the room have been doing for many decades, and the need for it never stops. It never stops. It's like a soap ad. You have to bring it every month, otherwise people forget. And with more and more investors able to access the asset class through evergreen vehicles, the need for that education and training just explodes out of all sort of historical proportions. Given that, isn't it better that a CIO allocates on behalf of a client in a professional, structured, strategic asset allocation manner via a discretionary portfolio rather than an investor buying a single product? And that's sort of the debate a little bit. So Jan-Marc, can you pick that one up for us?
Yeah, I mean, it's a great question, and just sticking to the question again, by 2030, will it represent a larger source? Probably not, I would say, at this stage.
I'm not doing very well, am I?
Exactly. But that's not a bad thing, and maybe I tried to explain why I think that's not a bad thing. So first of all, at least I think all of us here, we're client-led, right? And what I mean by client-led is a lot of our clients, they're very willing to delegate day-to-day investment decisions for all the reasons good or bad. But a lot of clients, they actually do appreciate the advice. So that's why the world kind of looks at discretionary and advisory. And we want to make sure we kind of serve both of those pools. And that's why I believe both areas, whether it's advisory or discretionary, will play a big role over the next few years. But then maybe the more challenging part for discretionary at this stage, obviously, is still going back to the potential illiquidity which you're faced, particularly in discretionary portfolios, where the clients delegate day-to-day investment decisions. And with that, obviously, one introduces a lot of reputational and fiduciary risks into these solutions. So depending on the sales process of the particular institution, where it's just being made very clear when a discretionary solution is being utilized, it's very clear to the clients, they understand this potential illiquidity feature, which obviously in an advisory conversation is still a bit easier right now, because you have that point at sales conversation where this surfaces and is not just hidden in a portfolio. But that doesn't mean private markets don't make their way into discretionary portfolio, and it's really driven by not just by the client needs, but and you mentioned it, being embedded in a strategic asset allocation, being driven by a CIO view, and an investment proposition which believes that you should not restrict yourself just to public investments, but that the best portfolio will be a combination of public and private market in investments, and that should be the driver of the allocation.
And just to pick up on what you said there, Jan Mark, I mean, we talk about private wealth as if it's one body of client, and of course it's not. Private wealth can be a family office with $2 to $3 billion with its own private markets team, all the way down to a core affluent client that perhaps has $2 to $3 million, and everywhere in between with ultra high net worth and high net worth. How do you, if you look at that question about discretion, do you think it's more appropriate that should be applied, insisted on, driven by organizations like HSBC for the core affluent segment?
I think it's a question of maturity as well, and I think what I observe is clearly, I think, what happens with private markets allocation, it filters top down. What I mean is ultra high net worth individuals have been engaging in private markets for many years. Yeah. But even typical high net worth private banking clients, have been way more hesitant. And one of the reasons, and I think we're going to talk about this in more detail, obviously, is because of the complexities, the operational complexities. Shortly we'll talk about that. Obviously, it is not very easy to scale operationally, to have more clients participating. But that's the big game changer we have in the markets which have taken place, and we talk about that in the last 2 years. So Evergreens is really the game changer, is the catalyst for again the democratization finally happening, because operationally it's now possible. It was not possible until a few years ago, and so these strategic asset allocation, which are more optimal, can find its way into core affluent portfolios over time. Not there yet.
Luke, Jocelyn, anything you want to add to that?
I actually have a question. There's been a lot of talk about the European Long-Term Investment Fund, the LTIF, and in the new LTIF 2.0 version, you can now have evergreen LTIFs, which is a product that, at least across all of Europe, can be offered to retail investors. So maybe this type of product in a discretionary portfolio is a new tool, or is it something new in the toolbox that banks and Luke, I know you're familiar with LTIFs as well. Is this something that GPs and banks are using?
Yes, actually, we have a lot of experience on that. The issue, and Simon, you were I totally agree with the fact that you should have at least two populations in the private wealth. You have the high net worth, above, I don't know what, but few million, 10 million. I don't know the limit. The people they're not very many, basically, and they have the ability to invest subsequent amount of money into professional funds. And you have the mass affluent, what we call the mass affluent at Eurazeo, what you're referring at the retail, meaning you're dealing with thousands, sometimes tens of thousands, sometimes even more clients. We do that a lot actually in France, in Belgium, in Luxembourg, through wrappers in insurance company, in life insurance company, through unit links. This is a big business in those countries. Also through banks who will do an allocation. And I think it's great. It's great and good for two reasons. First of all, you have a professional team who does an objective selection, try to avoid any subjectivity. So it's really scalable. So you can really have a solid construction with few allocation, few profile that then after a large number of financial advisors are going to offer to the clients. Again, as Jean-Marc was saying, the issue is the operational side. If you want to reach thousands and tens of thousands of clients, that means you need hundreds of private bankers and financial advisors, which are maybe not the best suited people to do an advisory allocation to the clients because they may not have the proper experience. So in this, I think for the mass affluent, discretionary is the future. I really believe so.
Yeah, I think so.
Yeah,
I think it'll take a while to come, but I do think it's the right and appropriate way to offer solutions to that segment. And Jocelyn, to your point, whether it's an LTIF or an LTAF, I see all of those structures converging into a semi-liquid or open-ended evergreen format. I mean, it doesn't make sense, I think, the 2.0 at the moment. I think there is scope for a 3.0 with a different portfolio construction and a different way of access. Third question, Jocelyn, I'm going to ask you to lead on this. So if historically high net worth clients access private markets through closed-end structures, 10-year structures, there's a wave of new open-ended evergreen vehicles. How much is the closed-end model being cannibalized, and how much is it that the new open-ended evergreen vehicles are just new clients? And where do we end up in 2030?
All right, so I think, Simon, your prediction, 50-50, I would have to probably disagree, I think, for the third time.
I'm going to get sacked, so then no one's going to invite me back.
No, I think evergreens really opens a new category, as you called it, 3.0. But I think before we talk about the predictions, maybe let's look at 2.0 a little bit more. So double click on this closed-end vehicle and why that has been a challenge really for the wealth community. And one thing that iCapital has done and part of our core business is to set up feeder funds, essentially access vehicles to amalgamate and aggregate lots of small tickets from, individual investors, essentially, and invest them into a private markets product. Now, historically, those private markets products have had very high minimum thresholds. So, something like $10 million to invest, very long and burdensome manual subscription processes, which are very cumbersome to fill out and then to process. And reporting has been mainly geared toward an institutional class of client. So, ultra sophisticated with, investment offices and people there to kind of translate these materials. So iCapital has made this process a lot more streamlined by, essentially offering these vehicles, these wrappers with reporting that's tailored to banks and individual investors, to digitize the subscription process, and to structure the vehicles in a way that make them more accessible to these channels of wealth. So closed-ended product, really the nature of it being drawdown and the investor having to make a commitment, but not actually to fund that commitment until they get an email or a capital call notice a few quarters later, and they say, "Hi, actually, you owe $5 million right now." So that is a cumbersome process for banks to handle for lots of individual clients. Also, there's the J-curve effect of a closed-ended fund. So the fact that there's an investment period, capital is called again in smaller increments, and then only after, a term, say 5 years, is the money actually fully invested, and then takes another 5 years to start to get distributions and to get that cash back. So that can be a difficult thing to explain to an individual investor, and it takes a lot of education and knowledge about private markets. So the evergreen format really has tried to address those challenges, and one way to do it is to say all capital is paid up. So you make the subscription and you pay at the same time. There's no J-curve effect, meaning your money is immediately put to work and you can stay invested for as long as that product exists. It's evergreen, meaning there's no end of its life. So you can stay invested forever, or you can take out, you have the possibility to get some liquidity along the way, might be quarterly. So this type of vehicle, and I think there are a couple of things that made this sort of possible. One is regulators, being more open to this type of vehicle and structure being offered to, certain types of investors. Again, it's not for everybody, which maybe argues with the term democratization, but it may not be for everybody. And these structures really have permitted then, been permitted by regulators. They've also, taken different parts of portfolio composition that a GP would take, different aspects of its investment thesis, and combine them together, add some liquidity pockets to that, and then create it inside of a product. So there are more and more of these coming to market. I think for banks and allocators, it's just an additional tool, again, that can be used in portfolio allocation. It could be alongside closed-ended funds. So there may be a class of investors that continues to prefer closed-ended vehicles. And then this is a way to deploy additional cash that's sitting in their portfolio. Or it could be, a way for a first-time investor to, kind of get their feet wet into private markets without having to stay invested for, 10 plus years.
Thank you. I mean, it's worth just repeating what Justin said there. I think when people look at open-ended evergreen vehicles, there's a natural assumption that everybody wants it because of the liquidity or the semi-liquidity. And I think a large part of that, of course, is true. But what Justin said is right. It's really important. There are other benefits. The lack of operational burden of capital calls, distributions, a re-up decision, portfolio construction, all of those things are done within the vehicle. And if it's an evergreen vehicle that doesn't distribute, in other words, it's a capital gain focused strategy, distributions that would otherwise have been paid out in a closed-end format get recycled into new investments. That means actually the multiple of money that can be generated by way of return is much higher than it is with a single 10-year closed-end fund commitment. So there are lots of advantages to open-ended evergreens, but I think it's, to go back to the point on education and training, it's just critical that we make sure people buy this for the right reason. And the wrong reason would be to say, I'm buying a trading instrument. I'm buying a fully liquid instrument. It's not. It's not. It's the underlying, as Luke said, continue to be illiquid. There are ways of providing that liquidity which go beyond the scope of this session, but I think that's a good point. But Jocelyn, very diplomatic of you. You said you didn't agree with me, but I'm going to push you for a percentage. Is it 50-50? What do you think it is? The closed ends still exist. I think you said yes, they do.
By 2030, I'd go 80-20.
80-20. Okay, there we go. I want to leave some time for questions. We've got 10 minutes to go. Our last question, though, before we do, and I'm going to go through this quite quickly. Do we really believe that all the education and training that we're all doing, the introduction of open-ended evergreen vehicles, is that going to lead to a 5-fold increase in the penetration rate, the number or the percentage of eligible clients that commit to private markets? And maybe we'll just go for sort of a percentage rather than a long discussion. But Luke, is 10% right? Too much? Too little?
I hope, because it will be good for all of business. It will be in line with what the institutional investors' allocation for private markets. 2030 is coming very fast, but maybe a bit less. I would say 8.
8. Jocelyn?
Yeah, 8 sounds good. Something less than 10, higher than 5. 7 or 8.
So you're going for a range from 5 to 8? That's quite a big range.
Yeah, I mean, I think, and we didn't talk so much about some of the operational hurdles that still exist, that we're at iCapital, that we're tackling as we speak, to make this market very scalable. So I think first step now, we have these evergreen vehicles, then how do we actually make them scalable, operate them in a way which has consistency as well across the industry, and bring some real industry standards to these types of vehicles and how they operate. So that's the reason I'm saying 10.
It depends. Yeah, Mark, push you for a number.
7 to 8.
7 to 8.
Closer to 10 than
Okay.
closer to 2. But I mean, some interesting data points, and we try to do the math. I mean, the challenge is massive, right? I mean, we're talking about huge amounts, and moving from 2 to 10 in only 4 years or 5 years is a big thing. But just to give you some data points, where since we have at HSBC integrated the private markets, in particular into the strategic asset allocation, new portfolios which we set up, they're very quickly at 20%, at the recommended 20% allocation. So we see the adoption. When we look what evergreens do in terms of the flows, 80% of the flows this year, 70% last year, are in open-ended evergreens, and only 20% is left in closed-end. That was completely the other way around 2 years ago, and out of that, half are first-time buyers of private markets.
So that means
it's really moving. It's really helping us to get new clients in, thanks to what you just outlined, this operational ease, and it works. This is real, and evergreen structures, obviously.
Great. So I wasn't quite as wrong on my fourth prediction as I was on the others, so that's a relief. Thank you, panelists. I want to open the floor to any questions. Do we have a microphone or? Great. So there's one here in the front, please, the lady in the blue shirt.
Thank you very much for providing your insight. So at the beginning, you talk about the democratization. I'm a big fan of it. But turns out, I think your guests not so much agree with you. So what I'm really interested in is to hear, different point of view, why you are. So I think you are a big advocate for democratization as well, and why rest of you not so much about it. Thank you.
So I think we're all a fan of democratization. I'll try and speak for all of us. We hate the word, but we're a fan of what it stands for, which is allowing more people to access private markets. But I think the process by which we do that, we're all very, very concerned about, because if that happens in a manner which is ill-disciplined, and there's a rush for market share, and people are sold things that they don't understand, that's going to be a really bad outcome. And so the process by which we deliver more exposure to a broader range of clients is really important. So the education and training is important. The vehicle structuring is important. The regulatory approval and making sure that it's approved for retail clients in a regulated fund, they're all important. So I think we're all fans of democratization, but not at any cost. I don't know whether anybody disagrees with
Yeah, I mean, I would maybe even replace the word to make sure investors can participate in the whole financial system in that sense, because we have restricted a lot of clients to public investments, and I'm not saying that's good or bad. Well, we have done that, but there is an investment universe, let's say, as big as the public markets, which provides over years a very important, great contribution and outcome where clients will end up in retirement and what they're able to save. And that's important. So I think it's that ecosystem's role to basically allow the access, but make it safe, as you said.
Thank you for
I
the
would
question.
just say that being smart and understanding private markets, it's not a matter of how much money you have in your bank account. So,
Gentleman with his
as long
hand
as
up.
the training is there.
And then afterwards we'll come to you.
Thank you. Following question, we were talking a lot about the democratization on the investor side, also meaning the demand side of private market. What about the democratization on the supply side, meaning, for example, your lovely platform, iCapital, to open for small, unimportant, unknown players on the alternative investment side, and not only maybe the established ones?
One for you, I think.
So I'd like to make sure everyone understands the question, because it's a brilliant question, and I think I think what you're highlighting is there's been such a proliferation of GPs offering open-ended evergreen vehicles, some better known with more scale, more history, more track record than others. Is it really okay that, or is it likely that all of them will succeed? Is that a fair way of rephrasing the question? No, got that wrong as well. I'm not having a good day.
Not that in the private market, as it is a quite kind of new, very diversified, different kind of asset classes. Also not only the established one with the old traditional style to have a fund, but just to refill the fund structure now with private market stuff inside. But there's also others, a lot, like premium wine, old timer,
I see.
legal finance. There's a lot, and this is also alternative investment. This is also private market, but it's not coming with the traditional investment fund regulations and structure, but it has to be paid attention to it as well. And this, like the platform iCapital, what about the democratization, for example, regarding registration process, to give a chance to out-of-the-box alternative investment vehicles, which might be smaller, agile, more fast than the traditional big ones like HSBC.
Apologies, I misunderstood your question.
As a complementary, not as a substitution.
Yeah, understood.
No. Okay.
We see a lot of niche asset classes and different types of investment strategies coming to the market. There's a lot of innovation as well around the types of vehicles, wrappers, everything from tokenization, which is a hot topic, to down to traditional fund structures. So we're keeping abreast of all of those market developments and very, welcome to be at the forefront of all of this innovation and welcome discussions.
We have time for one more question.
First of all, thanks to all of you for your insights. My question surrounds, again, this concept of democratization. We talked a lot about funds, private markets funds, and obviously this is a very big topic. But additionally, how do you think single access deals. So let's say secondaries of specific pre-IPO companies, for instance, blue chips, or private placements of bond issues. How do you think, which are actually becoming very popular through securitizations and all that, and more adopted, how do you think these single deals as opposed to funds fit in the democratization of private markets investing? Thank you.
It's another great question, and perhaps I'll preface the answer from my colleagues here with a comment around, if you think back to the democratization 1.0, 2.0, it was largely the preserve of banks that were offering private market solutions to their clients. Naturally, banks believe in, quite rightly, the concept of diversification. And a fund provides a good way to give an individual client a diversified exposure. When you get into single companies, you introduce a lot of concentration, obviously, but a lot of idiosyncratic risk, and a lot of factors that are beyond the control, perhaps, especially if it's a pre-IPO, of an active manager who can sort of take hold of things and change things. So I think that's historically been the reason. But Jan-Mark, anything that's going to change that going forward?
No, it's a very good question. I probably, from a distribution point of view, obviously, for, I should call it now, the lower segments, or where democratization plays such a big role. Obviously, the diversification plays an important role, and we want to make sure we select, managers who do that very well, very diversified, very safe outcomes. When I move up the client continuum, ultra-high net worth clients, and we talk about democratization there, if you are an ultra-high net worth client, a big client, 100 million, 50 million, billion, does democratization mean you get access like an institutional client? And I think it's happening, or it's happening, I think, for a lot of the players. But it is, maybe the key factor there is not the platform. It's probably not where I look to iCapital to help us. I think it's probably then more, make sure that very particular deal can be processed properly, and that we are a kind of connected to the ecosystem where these deals are originated. But we would be, as a distributor, very restrictive to very particular client segments. Yeah.
Luke?
Yes, I would say there is an issue of regulation and of scalability. Once you want to go into single operation, distributor will probably lack the agility to be able to get an opinion and to conduct and to forward some clients towards those opportunities, because often there's not much time available. So it might be providing the people who you will address those opportunities will be qualified, and this, each regulation in each country is different. Then maybe, again, technology may be a help. Those crowdfunding platforms, I don't really believe it will be a big business through banks, because it will be probably limited to ultra-high net worth individual, as Jan-Mark was saying. But we see quite some crowdfunding working with lots of risks. And again, we still to know the results, because often the company is slow to die, especially if it's successful in raising money. And it's kind of a dangerous game, but if you have the agility and willing to take the risks with all the framework of good regulation, why not?
I think we need to wrap up. If anybody has any other questions, I suggest that the panel sort of meets over here, and please feel free to come along and ask us questions. But thank you all for enduring the heat and being here in such large numbers, asking such great questions. But thank you most of all to my panelists. Thank you very much.
Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.